Welcome to the Ideal Investor Show. This is the podcast where we help you challenge your mindset and discover where you are. Tired of stories about other people's success? We can help you change your life, determine your time freedom point, and join us on the journey to financial success. Let's go. Hello and welcome to another episode of our Ideal Investor Show, where we bring you great guests that have experience and views and different options and diversity in real estate investing and other investing. And we have another great conversation set up for today with Taylor Loht, who was gracious enough to have me on his podcast. So we're basically reciprocating. Taylor, welcome to the show.
Thanks for having me today.
Yeah, absolutely. And I'm glad that we have another opportunity to talk a little bit. And before we do that, diving into the topics and kind of the specific stuff that you're interested in right now, tell us a little bit, how did you get into what you're doing? What's kind of the origin story for Taylor?
Sure. Like many of your listeners, I expect, I got frustrated with Wall Street type of investments. My investing career, if you will, started by reading one of the books on the shelf behind me here, The Intelligent Investor by Benjamin Graham. Teaches you about value investing in publicly traded securities. It was Warren Buffett's original strategy till he met Charlie Munger and they evolved and created what would become Berkshire Hathaway. And that got me started investing. I did that for a few years and was performing well, but ultimately I became frustrated with the inability to really drive value and create wealth proactively through that investment strategy. So I looked for other options. And when you go out there and search on the internet to try to find options, you certainly find a lot of scams. Back in the day when I was making this transition, drop shipping was a really big thing. It's still out there today, but it was really way back in the day when drop shipping was first getting started. So online businesses, all those things, and real estate is also, of course, a mainstay. And this was just right in the wake of the Great Recession when things were really starting to pick back up again. And I started to learn about how real estate investors can create value, can buy underperforming assets under the fair market value, if you will, fix them up, add value. And that just got me hooked. And I was particularly excited about larger assets and multifamily. And people always ask me for what drove me to multifamily. I can give you the list of pros of why we invest in larger assets and everything, but frankly, it's just exciting. I remember back in the day in the fall of 2011, if memory serves, I was driving my 2001 Volkswagen Jetta to a job that I hated at 7:30 in the morning on a cold fall morning. And I was living in a townhome at the time, a rental townhome. And I drove past the office of the townhome complex where I lived. Just happened to look at the office. I normally didn't, but I saw sitting in the parking lot at the office a brand new Audi A8. And I love German cars. I love Audis, all Porsche, all of it. And I just knew by looking at it, that's not the car of somebody who lives in this complex with us. It's, it wasn't a bad place to live, but nobody was driving a $100,000 luxury German automobile. And I knew that whoever owns that car also owns this apartment townhome complex. And that's the first time that it occurred to me that, hang on, people own all of these things around us. And I realized that it was possible. I didn't know how to do it. I didn't know that I can partner with others to buy these assets and build teams and all those other things. But I saw for the first time that it was possible to own these assets. And that's what originally got me excited about investing in multifamily. A couple years went by till I ended up taking action and everything, but it really boils down to getting frustrated with Wall Street and then seeing that real estate investors can create value in their investments, combined with, frankly, the excitement of owning these big things and partnering with other people who can handle the aspects of the business that I don't, enjoy.
Okay, yeah, that's very cool. And so if you were to describe what's kind of like the portfolio and the work that you're doing right now, how would you describe that?
Sure. So my role in our investments and the business that we do is I work with the investors who place their equity and invest in the properties that we invest in. So Texas multifamily. My role is, again, finding the deals, finding the people who operate the deals, and then finding the investors and essentially pairing the two up, and of course, investing in the deals myself. So a lot of working with the investors.
Okay. And so there are obviously a couple of different ways to go about that. In our case, for example, with Idea Rights Grower, we are staying deliberately and for certain reasons that we discussed on your show in the residential market, mainly meaning, single family, duplex, triplex, fourplex. So when you go into that commercial, like multifamily or storage units or stuff like that, are you mainly focusing on more like syndication type deals or straight out ownership for like a group of investors that partner together, or how would the audience have to imagine that?
Yeah, so our deals, we do syndications, and then moving into 2024, personally, I'll be working more on working with larger institutional type of investors that may wind up doing JV deals because they tend to invest larger checks. But on the what we would call retail side, investing with and doing deals with higher earning, busy professionals and higher net worth individuals through syndication.
Okay, yeah, that makes sense. And we had a few different guests that have explained how syndication works. So regular um, listeners to our show or who watch it on YouTube probably by now somewhat familiar with it. One of the things that I've always been curious, and it's probably applicable regardless whether you are a syndication investor or like in some group of people who outright want to own something. I mean, I can understand, and I'm even with our community invested in a syndication in the Austin area that is a brand new build on a piece of land close to the Tesla factory. And the numbers and the location and all that kind of stuff makes sense. But I've seen that there's also quite a bit of syndication opportunities for like properties that get bought to renovate or expand or stuff like that. So can you say a little bit how can somebody who might be interested might even say, hey, I like what Taylor was telling us on the podcast, so maybe I can participate. How do you make sure that the intended outcome of a deal like that or any of those deals actually materializes? And I'm asking this just to position it a little bit. In my opinion, in my limited experience for our syndicate deal that we are participating in, it's probably a 4 or 5 year, maybe even 6 year kind of endeavor from, getting the deal, getting the land, getting the permits, getting the contractor, getting construction going, finishing construction, getting all the units occupied and getting it to kind of, I would call that like a form of stabilized, so that then when it gets sold, it's really like a nice, bundle package, bow tie, whatever you want, like to say, okay, this is really nice and really worth a good chunk of money because the syndicators basically worked all the way to this point. Can you help at least to avoid disappointment, to say the least?
I think a big first step for any individual who wants to be in this space is to really take your time. Try to avoid the feeling of missing out, FOMO, as folks tend to know it these days, and get educated, learn how the business plans work, follow people who you're thinking about doing business with for enough time as it takes you to make a decision, whether that's you want to do business with them or you want to move on and look to do business with others. I think just taking a beat and taking whatever time you need in order to gather the facts, to build a relationship, to learn more about how the business works, that can solve a lot of individuals' questions or concerns about the market because you can make a more informed decision if you take your time to gather all the data, learn how the business works, watch the market, and ultimately make a decision. I think a lot of people who are in trouble in real estate today and in the multifamily space today were making assumptions that they didn't even necessarily know that they were making. And I was just seeing recently a Twitter thread, somebody who invested in a deal is actually in Austin, an apartment deal that frankly I didn't know about until the investors all lost their money, but I'm looking at it in a backwards looking sense. They bought this apartment complex in Austin with a team that was established, and they bought the property at something like a 3.7 cap with floating rate debt. So if you invest in single families, you're probably used to 30-year fixed rate debt, which is a great thing. You definitely can't say it any other way than that. Fixed rate debt for 30 years is a huge advantage for folks who want to invest in real estate. But in the commercial real estate space, the financing tends to be much shorter term. And these shorter term variable interest rate loans are pretty popular in the commercial space, and they were very popular when rates were at all-time historic lows. And a lot of folks were buying assets, whether apartments, office, or apartments and office, probably the biggest one, buying these properties at pretty significant multiples to their earnings, which is to say low cap rates, with also low interest rate debt that was variable. So when the rates went up faster than anybody expected, the folks who did those deals really got burned because their debt service costs, their mortgage payment costs went up so significantly. And I think the truth is that the folks who did that didn't even know that they were implicitly making an assumption that rates wouldn't go up that quickly. Now, hindsight being 2020, it should have been obvious that eventually the free money train was going to slow down or stop because the Fed had printed so much money through COVID to try to get us out and everything. But once the lockdowns ended and the supply chain stabilized, it was kind of a predictable outcome that the Fed would do as the Fed is supposed to do and raise interest rates in response to high inflation and relatively low unemployment. That's what they're supposed to do. That's their entire job. But for folks that were making those mistakes, I think a lot of people dove into those deals because they didn't understand a lot of the implicit assumptions that went into those business models, which specifically as they pertain to buying at low cap rates with variable rate debt in a low interest rate environment. You're stacking on top of assumptions on top of assumptions, and people didn't know what they were getting into. But if they'd taken time to learn how the business works, to learn how the financing works, they maybe could have seen that coming.
Okay. Yeah, I hear you. On the other hand, at least in my experience, when people talk about syndication investing, one of the benefits, if you want to call it that, that is frequently pointed out is that it's really, really passive, right? Like, so you're basically getting a pitch, you can review the documents, you can look at all those kind of things. And I would say for this particular scenario you were just describing, Taylor, with like the Fed starting to increase rates and stuff like that, I would totally agree that probably the majority did not anticipate the amount of increase and how short the period of time was. On the other hand, how I'm trying to imagine, okay, so I have the option, like if we were to work together and we had a client and you would say, okay, I want to help you get into a syndication, and I would say I help you to get into a single family home, right? And so let's just say it's or a duplex for that matter, right? And so that duplex is for whatever reason, $100,000 or $80,000 to $100,000 investment, and the syndication is a $80,000 to $100,000 investment. You mentioned already the 30-year fixed rate, and if you were able to do it like all the way up to early 22, it would be a really nice rate, right? And you never have to worry whether the Fed does anything or not. But on the what I'm getting at, what I like to ask is, so the syndicator did the pitch, everything looks good, and they obviously, I guess, like everybody in the financial world, would point to what's the track record. And I don't know what anybody would say. It is 5 years, 10 years, 15 years. Basically, in 2022, you could point back to a track record of 10 years or maybe even more than 10 years and have a almost perfect data to review, right? So what I'm getting at is when things actually change, how much can a syndication investor expect for those who are actually in the general management team to adapt to the change in the environment?
That's an interesting question. And we've seen a range of responses from general partners in that space. Some, and I think the right thing to do for general partners who wind up in a bad position is to do everything they possibly can to get their deal back on the right footing. This particular case that I mentioned on this Twitter thread was about things got so bad that there was basically no saving it. They may have mismanaged it. They put the wrong debt on it, all these other things. They lost all the equity, unfortunately. So there's probably not very much that the general partners could do. On the other hand, if things aren't quite that bad, and we see some scenarios like that, general partners can take less of a cut of the deal. They can bring their own capital to the table and should bring their own capital to the
Right.
table to maybe refinance or get another interest rate cap if that's the case, which those have gotten a lot more expensive, or do things that are required to get the deal back on the right track, whatever that might be. And a lot of times that really just means putting a lot of money in the deal, and for the general partners, saving their own reputation so that when things stabilize, when things normalize, when we're on the other side of whatever is happening today, the general partners can continue to have a business. Because in the situation where syndicators and folks are losing money for their investors, it's hard to see why would an investor in the future trust them with their hard-earned money if they had that big of a loss in this scenario. It's a very important question. Why would you? So what they should do is do everything that they can, both in terms of putting the work in to get their deal performing again, but also financially either supporting the deal or buying a rate cap or contributing in some way to get the deal reperforming. And there are a lot of folks out there doing that today. You just don't hear about it because if they're successful, then those deals don't get foreclosed on and there aren't these big stories of folks generally losing out. But comparing a syndication to, say, a duplex, like you're mentioning, well, some investors, they don't want to put the work in to manage a duplex. Even if you have a property manager, no matter what, no matter what asset you're investing in, your property manager still needs to be managed. On the debt side of things, if you're investing in a single family or an individual rental property where you're the only party involved, your debt might have recourse. You might be signing on the loan, so you're on the hook for the debt no matter what happens. That's not the case in a syndication for the LP investors. They're not on the hook for the debt. Their risk is limited to their original investment. So if you put $1 million in or excuse me, $100,000 in, it's more accurate. Put $100,000 into a syndication as an LP, that's your risk. You can risk losing that 100,000, but that's all the equity that can be gone. The bank is not going to come after you for anything more than that. They can go after the general partners depending on the terms of the loan and everything. That's a big concern for a lot of folks. Doctors is very big. They don't want a potential lender coming after them, or liability from tenants coming after them and their personal investments or their practice or what have you. So there are a lot of factors to be considered. Most folks investing in syndications, again, don't want to have an active role in the deal whatsoever, or they want to be in an asset class that they might not have expertise in, like self-storage.
Yeah, absolutely. And I hear you on that. I mean, the point about somebody coming after the person who invests, that's part of the reason why I'm always, and for our community, we're always recommending to put the assets in LLCs or land trusts that are then owned by an LLC, so that the risk, again, like you just said, basically the same idea, is limited to that particular property. And obviously, and I think the same is true in a syndication as it is for like a duplex or triplex or something like that, is that the asset itself is still there, right? So if you do like a 25% down, 75% with the bank, and for whatever kind of weird reason, which is much harder to construct in a fixed interest rate environment that we have always been and still are in right now, the only thing could be that you have so many and so many tenants don't pay that you just can't handle it yourself anymore, and then have to say, okay, to the bank, I can't make the payment in the mortgage. So obviously the bank would want to have the property back. But in our environment, even with everything that's been going on with inflation and all this other stuff, I can't see that a property isn't at least worth 75% versus what it was like 2, 3, 5 years, however long ago you bought it, right? Like the opposite is probably true, that if the bank were really to repossess it, they get their 75% plus X out of it if they wanted to. I would like to get back to in the stuff that you're specializing in. For somebody who says, I like this passive idea that Taylor is talking about, how can a non-expert investor learn or see, or what to listen for in the initial presentation to identify there is enough flexibility, or I kind of, what are the things to look for? How much can that be kind of limited in risk?
That's an interesting question. And there's so much to it. It's going to be difficult to cover everything. But I would start by, you mentioned the presentation that the
Right.
sponsor's giving about a deal. It's important to go beyond that, beyond what they're saying in the presentation, and validate at least some of the things that they're saying. If they're saying that, oh, we can take rents from $1,500 a month to $2,000 a month, and look at these comparable properties in the area that are already getting 2,000 or maybe even 2,100. So we're aiming to be a little bit conservative. Well, do your own research in that regard and check out those properties, those ones that are the comps. Are they in similar neighborhoods? Are they similar vintage properties where we could buy this target property and actually fix it up and get it to a space where a tenant would see the other properties versus the subject property and say, these are relatively comparable and they're both asking similar rents, so I'll make a decision related to that. Is that even possible? You can vet a lot of those things by going on Google and searching the comp properties, search the subject property, look at Google Maps. I mean, pull up the street view and see if you really truly believe and accept the idea that this property can be fixed up to the area where the space where they say it can be, because you're buying the property, but you're not buying the entire neighborhood. You can't change the character of the neighborhood. And it honestly, it surprises me sometimes how, frankly, few passive investors are willing to do even that basic level of their own due diligence on the property and look at the Google Street View and see, can this really be fixed up? Another factor that has become increasingly important to me over the last 7 years or so is just the age of the property. So I started out, when I started investing in apartments, buying older C-class properties. This is a few years before COVID, before we had all this inflation, interest rate changes and everything. And we were buying properties built in the 60s and 70s. And at that time, things were relatively cheap compared to now. And you could get an older property like that inexpensively enough that you could still have money in the bank to fix it up and raise the rents, and it wouldn't be that big of a deal. But we had all this price inflation as a result of COVID, in addition to the labor and materials price inflation. So the C-class properties, older properties, are more expensive now, and it's more expensive to fix them up. So for me, I no longer invest in properties built in the 60s, 70s, and earlier. I'll do the 1980s if it makes sense. And then 90s and newer is really the sweet spot that I like, because at the end of the day, you're buying an existing asset in its existing condition. And the older that it is, the more, frankly, skeletons in the closet that you're going to have. And a lot of those maintenance headaches that are going to pop up can be incredibly expensive to fix. And every dollar that you put into, say, fixing a plumbing leak is a dollar that you cannot invest in updating the floors or repainting the exterior, putting in granite countertops or what have you, impacting the overall potential returns. And that just comes down to buying newer assets in the first place. But to, again, take a step back and talk about the broader question, do your own basic due diligence, validate the sponsor's assumptions. Heck, if you're curious about the sponsor, Google their name, Google the company name, Google the individuals' names, and see how long they've been in the business. What are other people saying about them? Are there news publications about them, positive or negative? You might even be able to find podcast interviews of them talking and see if you think they are credible people. Now, that's them putting themselves out there, so it's probably a very, very tailored position or tailored impression of them and their businesses, but you can go even further than that and do background checks on them. We do background checks on the people that we do business with, but it's checking all those boxes. And again, this all goes back to what I said in the beginning about taking your time, avoiding the feeling of missing out, and really doing a lot of that due diligence up front. If you see a sponsor that has a deal that you might be interested in, but you're not ready to make a decision, go ahead and pass on the deal and just follow them. See if maybe you can find a passive investor who invests in the deal and ask them how it goes, or ask the sponsor for, hey, I didn't invest in this deal, but can I see the financials anyway? Because I'd like to see. They might say no, but they might also say yes. And you can make a more informed decision moving forward on whether you want to invest in their subsequent deals. That's something that I did personally when I was getting started. I wasn't quite ready to start investing or doing business with a particular sponsor, but I'm still trying to figure it out at that point. So I'm going to pass on this deal, but it's because I want to see how it goes so that I can decide if I want to do the next one. Because if the sponsor's in this business for the long term, the deal that they have today is not going to be their last deal, and it's not going to be their last good deal if it is indeed a good deal. So it goes back to take your time making your decision, get the information that you need so that when a deal comes around that fits what you're looking for, you're prepared to move forward. Just avoiding those decisions and really understanding what you're getting into, I think solves so many of those problems.
Yeah, absolutely. I'm totally with you. I was tempted to ask you if Taylor has a tailored list of things to look out for. Yeah, maybe you should do that. One thing that you had mentioned as in our setup for today's interview, assuming everything worked well, we did all the things that you mentioned that we should look for, with your help and a little bit of willingness to spend some time upfront to determine a good deal, got invested. And so now we're getting to the point where the original idea of having the investment in this deal for 5 years has, in my case, I mentioned this Austin deal, the intention is 5 to 6 years with at least currently the exit strategy to sell the deal to somebody who wants to operate this huge 360 unit apartment complex as basically a long-term buy and hold kind of operation. Now, you had mentioned that there is a way, and I don't know that many people are familiar or aware of the fact that there is, similar to what we do with our residential smaller units, an option for 1031. Can you describe a little bit how that works within the deals that you're supporting?
Sure. So what we do with some folks is bring them into our deals as tenants in common investors. So they are able to sell their existing properties, their existing portfolio, and 1031 those proceeds into a tenants in common interest in the LLC. So, or in the property rather. So in that case, you're not an investor in the syndication in the same sense as somebody who's investing with their, say, self-directed IRA or solo 401k or just cash. They're actually investing more directly into the property itself. And there are only some folks in this space who are able and willing to do a syndication with 1031 exchange investors because it is a lot more complicated and frankly, a bit more costly to get the paperwork put together to bring a 1031 exchange investor into a syndication deal as a tenants in common. So most people who will structure a deal this way, there's typically a minimum 1031 proceeds of $500,000 or $1 million. So it's not somebody selling a single family investment property in the Midwest. You're not going to be able to 1031 into a syndication. But if you have a larger portfolio, you've been in the space for a while, and you want to be what I'm starting to call a retired landlord, continuing to
Yeah.
1031 your proceeds
Uh,
into uh, larger properties and syndications and everything and roll that tax bill forward rather than paying it today, then you can 1031 into a TIC. TIC is what it's called. And you can go out and Google 1031 TIC, all the rules. The IRS has a particular set of rules out there that the deal has to meet all these criteria in order to be compliant. I think it's IRS publication 2002-22, if I'm getting the number right. And it's a number of different criteria that the deal has to meet in order to not be considered a partnership and in order to be considered basically a beneficial ownership in a piece of real estate. And anybody who structures deals this way should be able to do a deal that's compliant with that particular IRS regulation. But the point being of a 1031 exchange is you can sell existing investment rental property that's not a flip. You have to actually hold it for productive use is the term that they use. And you can defer the tax bill, both in terms of depreciation recapture and capital gains tax, indefinitely into the future. Now, if you get out of that 1031 exchange and you sell and take the proceeds to yourself and you disperse the proceeds, then that tax bill does become something you have to pay, but you can continue to 1031 into subsequent deals. And that's something that I'm working on doing with more and more investors in the second half of 2023, of course, as we talk today, and then more into 2024, because there are a lot of retiring landlords who are getting tired of the active parts of their real estate investments, because there is an active aspect to it, and they want to think about legacy planning, think about deferring that capital gains tax bill, locking in the gains that they've made over the years on their investment property, but also turning those investments into more passive ownership that they can efficiently pass down to their heirs. So that's what we're doing now with 1031 exchange investors. There are ways to structure it. There are, of course, other options for folks who want to do a 1031 exchange. There's opportunity zones, there's DSTs, and they all have their own different advantages and features and benefits and costs and cons and everything like that. But the 1031 exchange, in my opinion, is incredibly valuable and useful tax tool for real estate investors that even a lot of real estate investors aren't aware of. And deferring that tax bill down the road is just a huge advantage if done correctly. And I think we'll see more and more retiring landlords, baby boomers who want to think about their how much energy they're going to have into their 70s and 80s as they get older, and how they're going to want to pass down their wealth to their heirs. And the 1031 exchange, I think, will be a very big part of that.
And I totally agree with you. One quick thing, because I have always thought that would make sense for syndicators. You said earlier, obviously, somebody who is doing this for a business or as their business would not just do one deal and then never do one again, but they do a deal and then another deal and another deal. So is there actually an interest for syndicators to say, okay, I want to maintain my community, and so if we're exiting out of a deal, we 1031 into the next deal? Or is that rather rare?
Some syndicators do that. We've seen it happen. I personally haven't done a 1031 like that with the entire group selling a deal and then going into the next one. The difficulty is that it becomes really complicated to get that all together, because you need to take the LLC and sell the property and then roll those gains into a subsequent property. You have to have the timing all set up correctly. Most of the investors have to want to stay together rather than, again, lock in their gains and move on. So when you have a syndication itself looking at 1031ing and rolling into the next deal, it's just difficult from a logistical standpoint. Not all of your investors are going to be in a place where they want to do a 1031 into the next deal. You have to have a deal lined up to close in the right period of time. You have 45 days to identify after the close of your property, and then another 120 days to close after that. So really, the timing in a 1031 exchange, no matter how you're approaching it, is a huge part of the problem or the challenge that is put in front of us. So it does happen that a syndication will 1031, the actual syndication entity, sell a property and then roll into a next one. But it's pretty rare for logistical and timing issues, in addition to investors all having their own different goals and strategies, investment strategies and everything.
Yeah,
So
that makes
it's
sense.
rare
But
that it happens.
yeah, I think it also then is important to point out, as you just described earlier, the benefits. And, I always point those out for our residential real estate investors too. But it's also then probably more true to say, okay, when the syndication ends and the sale is done, and assuming everything that was originally promised is realized, then you probably also have to pay taxes on the income.
Yeah, a lot of folks will have depreciation built up that maybe apply against the gain, and yeah, everybody's got their own different
Right. Yeah. Yeah.
strategies.
Yeah.
Yeah.
Yeah, I mean, that's probably generally applicable. I'm just saying, like while in a residential deal, it's a little easier because, and I thought maybe there was an option, but I hear what you're saying, because even though a syndicator probably knows well in advance when the deal is winding down, but to make the timing work perfectly, especially with the identification in 45 days, is much harder than if I say, okay, I sell a house in, I don't know, Columbus, Ohio, but I'm only getting to the closing table when the next one is basically already reserved, so to speak, or under contract or what have you. So
Yeah, and let's say you've just for your deal that's a 4 to 6 year hold. Let's say you've been in 5 years, you're all ready to sell and kind of move on with your lives, and the sponsor says, "Oh, we've got this next deal, and we're making the decision. We're going to 1031 everybody into this next deal. It's going to be another 5 year hold." But what if you have maybe kids' college to pay for, and
right,
you
right.
didn't intend to roll those proceeds? You're going to pay for your kids' college. Well, you're going to be angry and maybe stuck in that subsequent deal for another 5 years, that's not consistent with your goals. You didn't sign up for that second segment of 5 years necessarily. So brings along a lot of headaches to try to 1031 the syndication itself.
Yeah, and I wasn't aware. I'm really grateful that you explained that it really only would work if the whole community of investors would be willing to do it together, right? Like I thought there might be a way to say, okay, well, if I put in 50 or 100,000, I can 1031 that part if I really wanted to.
No,
It sounds
you
like
can't
that.
because you have a 1031 has to be interest in an actual deeded property. When you invest in a syndication, you get shares in an LLC. You have shares. You don't technically have ownership or
Right.
partial ownership of the property itself. So it's a nuance, but a very important nuance.
Obviously, yeah, but you know, it's like everything, and that's a benefit. And you know, in a way that you don't have the liability either, right? Like if something happens, it's not really your complex or your property in that sense. So if people have gotten kind of curious, okay, this is all interesting, but I think it's been obvious in our conversation, there's way more to know. How get people in touch with you and reach out to you and say, hey, tell me more, and how do I really do this, and how can you help me?
Sure. You can schedule a call with me. It's, just a conversation by going to investwithtaylor.com or shoot me an email, taylor@ntcapitalgroup.com.
Okay, cool. Yeah, and we're definitely going to put that in the show notes. With that being said, I have two questions at the end of every show that I ask everyone. If you could meet anybody, Taylor, past or present, who would it be and why?
Well, that's really hard. There are a lot of interesting people over the years. I'm going to pick somebody who recently passed away just because he's so relevant to our modern day and had a lot of wisdom. Charlie Munger just recently passed away, and it would have been great to have the opportunity to sit down with him and maybe have a dinner or something.
Okay. Now, since there's a whole bunch of stuff about him out there, is there anything that you feel others haven't asked yet, or there's no YouTube about it or book written about it that you would want to ask him?
Honestly, it would be for me sitting down with him would be part entertainment value because a lot of his quotes and wisdom about investing were so pithy and valuable. But I'd also want to get his thoughts on kind of maybe the next 5 to 10 years of what he thinks is going to happen and where he thinks investors that are, I'm in my mid 30s, where we should be positioning ourselves to be in position like where he wound up with his life.
And 99 years is a long time, right?
Yeah, yeah. He made a long time, and he seemed to have fun.
Yeah, absolutely. I'm with you. Cool. The other question I always ask is if you had a time machine, forward, backward, you could go, where would you go and why?
So I'm assuming that I can come back to the present day, no
Yeah,
matter
It's
which.
kind of like Elon's Starship. You can go very fast and come back.
So this is a really hard one because there are a lot of interesting points in the past that you can go, and you can always think of some particular despot in the past where you would go back and take them out of commission, if you will, before they could commit their crimes.
Yeah, but then you don't know if you're going to be around, right? And the implications could be tricky.
Exactly. It's that time loop thing. I think it would be very interesting to go 500 years into the future and see where things wind up. There are a lot of important world events happening today that a lot of folks are concerned about. I do have hope that humanity will be around in 500 years. Hopefully we don't take ourselves out with some chat GPT like Skynet program.
Yeah.
But I think it would be very interesting to see where things are in 500 years from now.
Okay, yeah, I'm sure that would be super interesting. I'm actually pretty sure you're the first person who is willing to go that far into the future. One quick thing, and I want to just do this because we are still, like in the challenging time. Where do you see the market, especially in real estate, go in like 2024, 25?
So I always this is so tempting, right? I think it's important to try to avoid being an armchair economist because overall we can't control the direction of the economy. We can only position ourselves to deal with it in the future. So a lot of people think we're going to see some number of interest rate cuts next year in 2024. I don't know. Maybe if the Fed does start cutting interest rates, that could be a result of a pretty serious recession that we're seeing. So I think overall, preparing ourselves for recessionary conditions is a wise thing to do. I prefer, frankly, to focus on moves that I can make with myself, with my finances, with my family, with my wife, things that we can do and control. So that's, having cash available, having an emergency fund, all those very important things so that we can deal with conditions as they arise. In the real estate space, if we do see pretty serious rate cuts, interest rate cuts, then there will be, in my opinion, a rush into real estate. I think we have a lot of distress in the office market in particular, and a lot of major metros. Office buildings have just absolutely tanked, and we haven't seen that wash through the system yet. Some of those things have been worked out, but that could spell pretty serious distress for small and regional banks who hold those loans on their books today. So those are important things to look out for, but I think it's more important to focus on our personal financial decisions that we're making today and over the course of 2024, and try to remain just observers of what's happening and react to that rather than try to predict the future and read this tea leaves too much.
I agree with you. The one thing that I like to, for our audience, to maybe add to that is, and I'm just as guilty as anybody, is the more you get familiar with something, it's almost like a little bit like this walled garden kind of situation, right? Like being familiar with real estate in the United States. You mentioned, you can get a 30-year loan, fixed rate. You don't pay any penalty if 3 or 4 years later you say, I want to refinance it because the Fed lowered rates, all that kind of stuff. But when I zoom out, and I'm originally from Germany, I'm a European citizen as well, so there's a little bit maybe more of a tendency to zoom out. I'm looking at very fundamental big picture changes that I think are going on without claiming to have any idea where they're going to end up, that you could activate without having to scramble when everybody scrambles. So from this bigger picture, I still think the best place to be in real estate is in the US because of the whole rule set and the market and the size and all of that.
Yeah, I go back and forth about things like that. If worse comes to worse and we have a nuclear exchange, I hope I get hit first. I do not want to be alive in a post-nuclear apocalypse world. Recently saw that Netflix movie Leave the World Behind that came out that paints a pretty bleak scenario. I hope I'm the first one to go because I don't want to be alive in that situation. But overall, I think Ray Dalio talks a lot about internal conflict and external conflict and everything. And I think we do have too much internal conflict happening today. And the way to combat that conflict, if you will, push back against it, is to just be, I think, friendly with your countrymen and accept their differences, ideological or identitarian, whatever it is. Just accept those differences and work together to get past those things. Because if we're, for me, in a world where I have to bug out to Panama, well, I can't take everything or everyone that I care about with me to Panama or Colombia. So why would I want to go? This is where I am in the US, and this is where the people who I care about live, and all the things that I care about, this is where they are. And that doesn't mean I don't care about things internationally. It just means that if things go wrong, fleeing the people and running away from the people and the things that I care about, for me, would be the wrong response. So I prefer that they don't go wrong in that way, if that makes sense.
Yeah, I know. Let's hope that's not happening and you and I can keep doing real estate investing and helping other people. And, that would be the preferred option, I'm sure. So,
that's the plan.
Yeah, exactly. Okay, well, Taylor, thank you so much. And maybe, to see how we did with our predictions, we do this again next year this time. Yeah.
Sounds good.
Okay, cool. Thank you.
Thank you.